these were a good beat, but Whisper numbers were even higher. To put it into context, Nvidia normally beats by about $2 billion on the revenue line. This time they beat by about $1 billion, and the guide was about $1 billion ahead as well. And that's problematic for two reasons. One, investors are used to $2 billion, but also now Nvidia is a $30 billion a quarter run rate company versus $10 billion not so long ago. So, the magnitude of the beat is that much higher. I'd also note that it's the smallest beat in 6 quarters. So, it is a strong set of numbers, but expectations were very high.
Ben, was there anything in those reports to concern you? I know people have looked very closely at some of the details around the gross margin slightly falling, and the forecast for mid 70% versus perhaps a slightly higher expectation. Of course, as you've alluded to, also those percentage growth rates also falling. Anything in there that was a concern at all?
Yeah, so gross margin is closely watched by semiconductor investors because it's a proxy for sort of pricing power and the strength of the business. And as you say, they're guiding a little bit down in Q3 and then potentially down even more in Q4. And that's, not a good sign. However, that is totally explainable because they're bringing on Blackwell, this new product. Those new products always start at lower gross margins, so there is a dilutive mix effect on the gross margin. The other thing that's important, I think, is the OPEX has been guided up as well, and so overall margins are going to be coming down. So you've got a beat, but then you've also got some margin pressure as well, and so that's meant that earnings estimates are largely staying flat. And normally after an Nvidia quarter, you get earnings upgrades, and so that's a different scenario than we're used to at Nvidia.
And Ben, many have spoken this morning to us about the visibility of this company, beyond just this year into 2025. One of the themes of this earnings season was big tech essentially upping their capex, investing in infrastructure. That looks set to continue this year for sure. But do we have a view at this point of what's going to happen next year for Nvidia?
Yeah, I mean, this is exactly the issue. It's always trying to think about 2025, even 2026 in terms of the growth rates. As you say, the biggest driver is the capex of the cloud providers, and that looks like it's on an upward trajectory. The one thing I would always caution, though, is that historically we've always seen periods of digestion by the big cloud providers as they sort of absorb some of the spending that they've done. And we haven't seen that yet for Nvidia. So that could be on the cards maybe in 2026, something like that. So that's something people are worried about. I also think energy constraints are also an issue that people watch very closely. In terms of supply chain, that, HBM and CoWoS capacity looks to be ramping reasonably well. So those are all the things to watch for. But fundamentally, what Jensen was talking about last night is the diverse and strong demand for both the Hopper product and the Blackwell product. So growth continues to be strong, but as you say, this company is priced for strong growth, and maybe we're getting to good growth, not great growth.